Joining us now is Thomas Hayes. He is the chairman at Great Hill Capital, joining us from here in New York City. Tom, thanks for making time to chat with us. You and I were talking a little while ago about the fact that there seems to be powerful momentum right now happening for the U.S. equity market. I think the S&P 500 closed Friday at yet another record. We have seen 6 straight weeks of gains. Is this a little concerning to you?
A little bit, particularly because of the seasonality, Doug. So this is the 7th time in the last decade the S&P has been up 6 weeks in a row, and it's basically a coin flip based on history, whether we get a 7th up week this week, about 50-50. So we'll see what happens. But I think what you're seeing here, Doug, is a combination of complacency plus liquidity. Most central bank cuts in the month of September that we've seen since 2020, and prior to that 2009. And then you couple that with, if you look at betting odds, if you place any weight on betting odds, potentially the market may be pricing in a shift to slightly more pro-business policy. Whether premature or not, it seems to be telling the story, particularly when the market's going up and earnings came in a little bit lighter than expected so far.
So stocks are up, yields are down by and large, and we had Raphael Bostic saying at the end of last week he's not in a rush to lower interest rates. Do you think the Fed may be a little concerned here? Put aside for the moment the labor market, put aside for a moment this decline that we have seen in the rate of inflation. Is the Fed perhaps a little concerned about easy financial conditions?
Well, they have shifted to a dual-sided risk, and the labor market, as low as the unemployment rate is, it is showing some signs of weakness. Now, are we guaranteed getting 6 consecutive cuts in a row? The market's been a little bit too optimistic, so I'm not sure if November is a foregone conclusion. I think the market's pricing in 225 basis point cuts, but maybe we only get 1. I think that's perfectly fine given the current conditions. The other thing that I've really had my eye on, Doug, is last month we got a record move out of bonds, a 2 standard deviation move out of bonds. And you got to look back all the way to 2001 to 2003 to see that level of move. And if you remember, and I think you were around back then, Doug, you had an unprecedented rally following that in small caps versus large caps, in value versus growth, and in emerging markets versus developed markets. 3 trades that very few people are confidently positioned for right now.
I want to change gears, talk a little bit about the other side of the world, the Asia Pacific. In the week ahead, markets in Asia are gearing up for what is likely to be the busiest week of new listings in more than 2 years. Particularly, it's China, it's India, it's Japan. What does it say to you that developing markets are in the process of raising a lot more capital?
Yeah, the game is back on. Animal spirits are coming in. The Chinese government has flipped on the dime. Yes, investors want more. Yes, investors are skeptical after a 2-year beatdown. And yes, they are going to get more because why? Because you can't be half pregnant. They've already turned the corner. They're going full bore. They will do more, and then they will do more, and then they will do more. And the Chinese government, the game is back on. We're going to see more fiscal stimulus coupled with the monetary stimulus, coupled with backstopping the property market. And when that happens, massive flows. And I think, and you mentioned Japan there, some of these emerging markets that have been the beneficiary of emerging market flows out of China, like Japan, like India, that have gotten a little bit heated, I think we're going to see a little bit of weakness in those markets as money slowly and more confidently over time moves back into China, particularly the most high quality companies in China. And the IPO market, the slate that you mentioned, tells you everything you need to know about confidence recovering and starting to rebuild.
So are you a buyer of risk assets in China right now?
Yes. One of our largest positions is Alibaba. This has been like watching paint dry. It's been dead money for us for a year. We spent every red day buying more stock. People looked at us like we had three heads. But here's the fact, Doug. You can buy Alibaba today for the same price it was 10 years ago. The only difference is the revenues are up 1,300% and the earnings and cash flow are up 650%. So what else do you want to talk about? I mean, we see it as one of the greatest. Price is what you pay, value is what you get. And in terms of the cash generated, they generate $20 to $25 billion a year in cash. They got $80 billion of cash on the balance sheet. They've got a piece of basically every AI startup in China. They give them credits for compute power in their cloud business in exchange for equity. I mean, if you wanted to play an AI ETF in China, it's called Alibaba, and that's got zero credit in the price right now. Couple that with AI, with the cloud, and with the consumer coming back with the fiscal stimulus, it's the toll gate for China. So we like that position, and we love the valuation at high single digits, down from historic multiples of 20, 25 times, and they'll come back over time.
Let's talk about the U.S. presidential election. We're a little more than 2 weeks away from November 5th. Obviously, it's a critical day, or will be. How are you feeling about the election, and what would Trump presidency mean versus Harris presidency for the business environment in the U.S.?
Yeah, it seems like the market is starting to price in slightly more pro-business policy, which implies a Trump win. That's evidenced in the data, in some of the polling data, and certainly in some of the betting data, in some of the betting pools that you look at. It's starting to favor a Trump win. I think betting on the basis of who's elected is a fool's errand. If you recall, when Trump got elected, everyone said China stocks were going to do horribly. From 2016 to 2018, China stocks did better than they've done in years. And then when Biden was in, they thought China was going to do great. It did horribly, the worst it's done in a decade. Furthermore, everyone said when Trump would get elected, energy stocks would go to the moon. The exact opposite happened. When you have more drilling, the price goes down, and the stocks went down with it. A lot of supply was not good for energy stocks under Trump. So I think that what the ideal outcome from a stock market standpoint, Doug, is just a split government. So whether Trump is elected or Harris is elected in the executive branch, so long as you have a different party in either the House or the Senate, the market loves gridlock, and empirically, the market does best with a split government. So that's what I think we want to be focused on as market participants in the next few weeks.
Okay, so if you're reading the data properly, or at least these indicators that you're looking at right now, and there is a higher probability of a Trump administration, do you really believe that additional tariffs are pro-business?
Well, look, I've seen some studies on the impact if Trump actually put forth the 60% tariffs on China. The data that I've looked at implies that that would only reduce Chinese GDP by 1%. So we would potentially, in the short term, bear the brunt of the higher prices. However, as some of his selected potential Treasury secretaries and trade negotiators in his formative administration have implied, that is the ask. It is open to negotiation. And Trump has said as much. We just want to do a deal. So he'll hit them hard, bring them back to the table, and try to get a pragmatic outcome. As we saw in the early part of the administration from prior to COVID, that he did have some success in doing that. And the subsequent administration actually followed through and kept the tariffs he put in place active during the Biden administration. So I think it's more of a let's get to the table, but first I'm going to bop you, and then I'm going to hand you an ice pack to help heal together and make something that works for both parties. And I think we'll see a pragmatic move after the initial shock factor.
All right, we'll leave it there. Tom, thank you so much. Thomas Hayes is chairman at Great Hill Capital, joining us here on the Daybreak Asia podcast.
Thank you, Doug.
Thomas, thank you.